Hello, guys. Good day, good evening, good morning, wherever you are. Um, I trust you are all doing well. Um, Welcome to another session where we'll still be talking about cost of capital. Like I said, the cost of capital we are talking about, we are laying more emphasis on cost of equity, which is K. And I've already mentioned that there are three methods to get KE. So we are still talking about the first method, which is capital asset pricing model. We have dividend model and Milan Modigliani. So we are still going to be talking about capital asset pricing model in this session. Um, because it's a bit wide, and examiner have a lot of ways to set questions around capital asset pricing model. So actually, I just want us to look at another kind of question different from the one we solved in the last video. So I'm going to really go to the question now, and the question is taken from November ICAN exam November 2016, question 1. November 2016, question 1. Please allow me to share my video right now, my screen, rather. Okay. Okay. Um, okay. I believe you can see my screen now. Okay. Now, so the way it works here is, just a minute, please. Um, okay. 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 Very well. Okay. Now, question 1. Okay, I want us to go to, let us quickly go to the requirements. Okay, we are going to pay attention to just requirement A and requirement B, which say requirement A, calculate the current total market value of TPs. Okay, current total market value split into equity value and bond value. Okay, so what they are asking from us here is that after calculating the value, we add the two values together, value of equity and value of bond. We have it together. We have not gotten to value of equity. We just calculate it. When we get to business valuation, you see how we do it properly. But we've done value of bonds in previous videos. Okay, please. So let us manage. Then in step 2, we are going to be calculating the risk-adjusted cost of capital. Risk-adjusted cost of capital. That is what our answer is going to be in the nearest percentage. Okay, before we go there, okay, let's go back to the board. I want to quickly explain something. Okay, so this is what I like to explain here. I want to explain, like I did the other time, I explained steps it will take to calculate risk, to calculate risk adjusted cost of capital. So this time around, and I said we have 5 steps. So this time around, I want to share steps to calculate combined cost of capital or work of combined activities or overall cost of capital. Steps steps to calculate overall cost of capital or work of combined activities. Okay, or we call it overall work, anyone. So when we say overall cost of capital or cost of capital of combined activities, when we say activity, we are looking at several things company does. Some company, they call them something holding company. They have agri business. They have um, production of beverages like water, like they do that kind of business. They have um, they have all hospitality business, So, like for a very good example is Dangote. I always use Dangote as an example. There is Dangote cement, Dangote sugar, Dangote salt, Dangote petrochemicals, and others. See, all these companies, these are each of these companies from Dangote. They are called activities. There's activity in sugar industry. There's activity in salt. There's activity in petroleum industry, and so on, in oil and gas industry, and so on. Now, these are all activities. So there is a possibility that we want to calculate the cost of capital for Dangote Group as a whole, the Dangote combined company. So what we are going to do, we are going to be bringing all the business risk from sugar, salt, cement, petrochemicals together, and we make it one. Then we use it to calculate a single cost of capital. So that is what we are doing here. And we get this kind of a thing in the exam as well. All right, let us go on. Step one is still to get proxy. Yes, just like you will get proxy when you are trying to evaluate a project, get a cost of capital for a project that you want to diversify. This is the same thing. But in this case, right, you want to calculate, for example, I'm picking Dangote Industry. That is the Dangote Group. That is the company that owns Dangote Sugar PLC and so on. So I'm picking Dangote Industry. Now, if we are calculating combined work for Dangote Industry, who are the proxy we are going to pick? They are the subsidiary of Dangote. Dangote has sugar, salt, um, cement. So these are the companies we pick now as proxy. Now, those companies have to be a publicly quoted company. That is, their shares has to be on the stock exchange so that we can trust every information we are getting from them, because they will be highly regulated by government agencies known as SEC and other agencies. So we can trust the information we are getting from them to a reasonable extent. Now, it's if in the example, one of the subsidiary is not a public quoted company, it is possible examiner, maybe for example, Dangote Cement is not a public quoted company, I'm just saying. So it is possible examiner give us another cement company that is a public quoted company. So that would be the proxy we are going to use um, in place of Dangote Cement. So something like that, but they've not done that like that. But what examiner has done in the past is to say, okay, this company, they want to start this project. They are now having another project again, and they are now doing 2 or 3 activities, calculate the combined work. So we use what they are doing currently as the proxy. And what we do for proxy, you already know, we state all their details, 3 major details, basically. Beta equity, beta assets, and beta equity, sorry, value of beta equity, value of equity, and value of debt, if need be. Okay, step 2, on gear. So on gear means that we are going to calculate beta assets. Just in case when we're getting proxies information, examiner gave us the examiner gave us examiner getting proxies information, examiner gave us beta equity of all these subsidiaries which are the proxies. Then we'll ungear them. If there are 3 of them, that means we'll calculate beta asset 3 times for each of them. Okay, we calculate beta asset for each of them, which means we are calculating it 3 times. Then step 3 will be that state market value of each activity. State market value of state market value of each activity. Step 4, calculate combined beta asset using the weightage of activities market value. So we are going to be using the weights of activities market value to calculate combined beta asset. Now we'll weigh it. How do we weigh it? We can use the market value. What is the value of cement, value of sugar, value of salt? Add them together. Oh, all these values equals to 200. Out of 200, value of cement is like 110. So we now say 110 divided by 200. The value of salt is like value of salt is like 20. Then we say 20 divided by 200. And maybe value of sugar is like 70. We say 70 divided by 200. That is the weight. So that is what we call proportion. Portion. Then we multiply each weight by their respective beta asset, and we add the weighted betas together. That's how step 4 we go, but I'm still going to demonstrate it using a small formula. So step 5, after we are done with step 4, we would have gotten a single beta asset. We would have combined all the 3 or 5 beta assets together to become one. After that, in step 5, what we are going to do is regear. You're familiar with it, regear. Here we are using beta equity formula. The beta asset we got in here for the combined one, we put it in beta equity formula to calculate combined beta equity. Then step 6, we do capping. Then we put the beta equity combined inside capping to get cost of equity combined. Then step 7, we calculate WACC. The cost of equity combined in step 6 is going to be in the WACC calculation to make the WACC combined WACC or overall WACC. So this is the 7 steps. Okay. Now, let us go back to the question I was sharing initially. Okay. Please, I believe you would have opened the question by now from your end. All right. November 2016, question 1. Now, I want to quickly read. I've read the requirement, which is calculation of market value, equity and bond, and calculation of the risk-adjusted cost of capital required for the new project. Okay, very quickly, let me go to the story and read. Please follow the story and be reading it as well. If it's too fast, you can pause and read the story to digest a little bit and digest the information a little bit before you continue with the video. Thank you. Okay. Tinko PLC repairs, TP, repairs and maintains heavy-duty trucks with workshops all over Nigeria and number of countries in Africa. Below are extracts from the most recent statement of financial position of TP. Shareholder, share capital 50 kobo per share. Reserves, non-current liabilities, current liabilities. TP's free cash flow to equity. TP's free cash flow to equity is currently estimated at 150 at 150 million and 153 million, and this is expected to grow at 2.5 per annum to infinity. The equity shareholder requires a return of 11%. You see, this place we got to, we can use this information that we have gotten now to calculate the market value of equity. And let me quickly do that. And by the time we get to business valuation, you will understand it better and better because we are going to discuss it in the business valuation. Okay, let me move to the next slide. Okay, I had, okay, for this, we have TP Tinko PLC. Okay, market value of equity. It is equal to, we call something free cash flow to equity, 1 plus G, that is growth rate in free cash flow, divided by KE minus G. So the market value of equity would be, what's the free cash flow to equity? They said it is 153 million naira. Okay, 153 million naira, growing at 2.5% per annum to infinity. That is 0.025 plus 1, that's 1.025. Okay, 2.5% is 2.5 divided by 100, that's 0.025. 0.025 plus 1, that's 1.025. All divided by cost of equity, which is 11%, 0.11 minus 2.5%, 0.025. So what is our answer here? I am punching my calculator. Okay, so I'm going to punch it straight away. 153 times 1.025. I got 156.825. I say divided. Because I'm saying divided now, because I have 11 minus, so what the denominator, I'm going to put them in the bracket. So the calculator will give me the correct answer. Open a bracket after I press divide. Open a bracket, say 0.11 minus 0.025. Close the bracket. Then I say equal to, then I get correct answer. So I am getting 1,845,000,000. That is the market value of, that is the market value of equity. I hope that's a bit clear, but I would really explain. By the time we get to business valuation, we are done with business valuation. You would have understood why it is like this. But let us go to the one you are familiar with. Okay, let's go back to the question rather, to the reading of the story. Now, look at what I am doing here. Well, you can say because I know it very well. Okay, the thing is this, I'm also trying to show you that if you practice so well that you know all those things very well, by the time you read the story to a particular extent and feel like one of the requirements, I have already gotten everything I to calculate it. Please quickly calculate it. Look at that. The mark to that one is 3 marks. Okay, it's 3 marks, and you can just, I just did it in less than 2 minutes, right? And that's the thing. So then going back to the story, then start reading the story. If you have all the information you need to do another, quickly write the answer. You don't have to finish reading the long story before you even start at all. Okay, let's go on. The next paragraph says, that is, the last thing I read was 11%. Return, required rate of return. Next paragraph says, the company non-current liability consists entirely of 1,000 naira nominal value of bonds, which are redeemable in 4 years at par, with a coupon rate of interest of 5.4%. The debt is rated BB, and credit spread on BB rated debt is 80 basis points above the risk-free rate. So this information is going to be used to calculate the market value of bond. And we have done it in past, in previous videos. So you should be able to do even this on your own. Okay, now market value of bond. Market value of the debt or bond. What do we need? We need coupon. What is our coupon? Our coupon is 5.4. It gave us 5.4%. 5.4%, which is equal to 5.4%, which is equal to 5.4 divided by 100 times 1,000 naira. It is equal to 54 naira. Then we need redemption value. Redemption value. Redemption value is equal to 1,000 naira because they said it is going to be redeemed at par. Then we need maturity. Maturity is what? Maturity is 4 years. Okay, it is well spelled out in the story. Maturity is 4 years. Then yield. They said the bond is rated BB and the credit spread on BB rated debt is 80 basis points above risk-free rate. So when we say 80 basis points, that is 80 divided by 100 plus, that is 80 basis points. So what is risk-free rate? You can quickly go to the second to the last paragraph. Okay, yes, last paragraph. Okay, before requirement, the paragraph before requirement, you will see the risk-free rate is estimated to be 4%. Okay, the risk-free rate is estimated to be 4%. So that is 4, that is equal to 4.8%. So this is going to be our cost of debt. You know, we are also asked to calculate weighted average and the project adjusted cost of capital. So this is what we are going to use as cost of debt when we are calculating the cost of capital. Okay, so very quickly, let us calculate the yield to maturity. Let us calculate the market value of bond or of the debt. We say year, okay, year 1 to 4 and year 4. I have cash flows as well in naira. Bond year 1 to 4, 54 naira. In year 4, redemption value 1,000 naira. Our discount factor is going to be 4.8%. Okay, our discount factor, it is going to be 4.8%. So use what is the annuity factor? Since we have constant cash flow, what is the annuity factor of 4.8% for 4 years? I say 1.048. I'm punching my calculator, raised to power -4. I got something. I say 1 minus whatever I have gotten, then all divided by 0.048. I am getting 3.562. 3.562. Then what is the present value factor? 4.8% for 4 years for year 4. 1.048 raised to power -4 equals to 0.829. Okay, then our PV in naira is going to be, our PV in naira is going to be, we have 3.562 times 54. I have 192. Okay, let's just say approximately 192. Then 0.829 times 1,000, that is 829. Add everything together. 829 plus 192. I got 1,021. 1021. Now, if you want to calculate total market value of debt, therefore, market value of debt would be equal to 1000 and will be equal to 1021 per 1000 divided by unit, that is 1000, times what is the nominal value of the non-current liability, that is 760, okay, divided by 1000 times 760. I got 775, approximately 776. Okay, like 776 million approximately. Okay, so I got 775.96. That's why, or let me just say the real figure equals to 775.96 million naira. Okay, so that's our total market value of debt, and we have gotten value of equity before. So I will restate them here. I say market value of equity, okay, equity, and market value of debt, which is bond. Bond is 775.96. Equity, what did we get? 1845, I think so. We got for 1845, yes. Okay, so 1845 plus 775.96, we got 2620.96 million. Okay, so we have this. So this is going to be our total market value, that is VO, right, for TP. That is the VO. Okay, now if we are going to calculate cost of capital, this is what we are going to use. Okay, very quick, let us go back to the reading of the story. Okay, they now say, next paragraph. The government recently launched its Graduate Back to Land program, in which graduates are being encouraged to take on high mechanized farming. The program will involve massive importation of heavy-duty agricultural machines like tractors, harvesters, dryers, etc., for distribution to graduate agri-club all over the country. However, there is a growing concern within the country about the possibility of effective maintenance of this machine. TP is therefore considering entering these markets through a 4-year project. Okay, sorry, please, I'll be back with you in a short while. Okay, now, so we've done reading, okay, project, they'll do the project for 4 years. Okay, the project will cease after 4 years because of increase in competition. So what is happening here is this. Okay, Now, from the story, government launched a program. So there's going to be a need because farmers will be more, they will buy tractors, harvesters, and so on. There is a need for a business to, there's a need for maintenance of all these machines, right? So there's no company who does this. So TP wants to enter this market. So it's a diversification for TP. So they are diversifying because what TP currently does is maintenance of heavy duty trucks, okay, like Caterpillar, like maybe all those equipment they use for construction, but they are different from agricultural equipment. So that is another kind of diversification. Okay. So I just want you to please find a way, try to decode where companies are diversifying because they didn't really mention diversification here. In some cases, they will say the company wants to venture into a new business that they've never been before. It's also a diversification. So when you are reading like that, you notice that it is a diversification, all right? You can skip because you want to do cost of capital. So all the information we don't need then. Now come to the second to the last paragraph, the two paragraphs before the required. Now they said, although, I hope you can see that, although there is no beta for companies offering maintenance services for only agricultural machines and equipment in the country. Abaco PLC, a listed company, can you see? They said a listed company. So proxy will always be a listed company. So, or proxy can be an investment banker who knows the market very well. Okay, a listed company offers maintenance and related services for construction, mining, and agricultural equipment. About 15% of its business is in the equipment of now of maintenance services in agriculture. AP has an equity beta of 1.6. It is estimated that the asset beta of non-agri maintenance sector is 0.8. Now, what they are saying here is that AP has two activities: maintenance of non-agri, maintenance of agri equipment. Good. All right. AP's shares are currently trading at 4.5 4.5 per annum, 4.5 per share, sorry, and its debt is currently trading at 1,050 per 1,000. It has 80 million shares in issue, and the book value of the debt is 340. The debt beta is estimated to be 0. Okay, before we continue, I wanted to say something about I wanted to say something about I wanted to say something about the 7 steps I mentioned, because this question we are going to enter that 7 step a little bit. So that's step 4 that I said combine beta assets. So this is the formula. I will just say the formula for combined beta. Combined beta. Okay, it is equal to, it could be beta assets, it could be beta equity, combined beta. So the formula can be used for both of them. So combined beta is equal to beta of activity A times portion of activity A plus beta of activity B times portion of B plus beta of C times portion of C. So this is how you calculate combined beta. That is, so this portion, that is why we need to get the market value. What is the portion in the whole of the business? Oh, activity A is, the value of activity A is 110 million. Then the total market value of all the activities is 200 million. Just say 110 divided by 200, that's the portion of A. Activity B, the portion is 20. Just say 20 divided by 200. That's the portion. Activity C, the portion is 70. Say 70 divided by 200. That is the portion. And when you are doing it, you get 0 point something, which is also equivalent to, you can say something, something percent, 20%, 4%, 10%, and so on. So examiner can, instead of saying, giving you the market value, they can say the portion of this company, of this one in the whole company is 15%, 6%. That's all. Okay, let us go back to the question. Now, okay, we have um we have okay, we're done reading the question. So we are going to really solve this question, which is we are moving to question B. So in this video now, we've been able to solve question A, and our final answer for question A is our final answer for question A is 2620 0.96 million, 2,620,960,000. Okay, so that is that about that. Okay, in the next video, we'll continue to solving this particular question, moving to question 1B. Thank you very much. Cheers. See you in the next video.